Welcome to MarketTamer.com. You're looking at a chart of US real GDP growth. And today in this video, we're going to spend some time talking about what the causes of the crisis were and hopefully provide some insight as to why there were incentives to lever up heavily. Because in retrospect, it's often easy to look back and criticize, but if we actually step back in time and see what were people looking at the time that risks were taken, sometimes we get even better insights into a crisis in retrospect, which can then help us mitigate risks in the future. So first of all, we're going to keep an eye on this chart, and the thing that is worth noting is that for the first part of this chart, from about 1947 through to 1985, what you see are very big changes in GDP on a regular basis. Whereas from about 1985 onwards, what we see is a much greater contraction, that is much smaller changes in GDP. And that's been described as the Great Moderation. Now, if you think about this from the perspective of, say, a profit maximizing manager at a company or an executive at the corporate level, what is their incentive to make money? Well, they're trying to generate yields and returns based on what we're seeing here is a contraction in volatility. Now that's often tough. As you know, playing the options world, if there's a lot of volatility, you can often make greater returns more quickly. In the world of corporate executives, in order to try and generate some yields, and attractive yields at that, when there's not much volatility, often what's needed is leverage. And a way of thinking about this is maybe think about a car and think about the evolution of the car industry over the past 40-50 years. What we've seen is a great development in safety standards, whether it's just seat belts or just greater infrastructure, greater reinforcement surrounding the car. The bottom line is that cars are much safer now than they were 40-50 years ago. So to some people, that means that they can drive faster because they know if there's a crash that they're going to be much better protected than if they were in a car 40-50 years ago. So in some respects, the incentive is to speed as a result of knowing that there are greater safety features in the car. Similarly, if we apply that analogy to the market, what we see is executives at the corporate level looking at the reduction in volatility, believing that it is safer because there aren't going to be wide swings in GDP changes, are going to feel the incentive or the need to lever up and enter projects that are maybe higher risk. Ultimately, what it means is an underpricing of risk due to the fact that the once in a 20, 30, 40 year event is not factored in. In fact, looking at all the statistical models back over time, if you were looking at S&P or Moody's or any of the rating agencies, what they were factoring in terms of home prices was at most a nationwide correction of 3%. Why? Because if you were to look back over time, 3% was the maximum that had occurred in terms of a correction in nationwide home prices. So looking at the data, it seemed pretty normal to say, okay, there's not going to be a correction in the future of 3%. But that ties in absolutely perfectly with Nassim Taleb's philosophy, which is more the black swan event, which really speaks to the fact that these bizarre or black swan events actually occur much more regularly than might be thought of. In fact, one of our partners here was telling us about a flood occurring in Atlanta, Georgia, and I think it was last year or maybe the year before, there was a flood, and it was considered maybe a once in 100-year flood. But then this year there was a once in 500-year flood. And so often these so-called events that are very, very rare actually occur much more frequently than is anticipated. And that really catches out people, not just obviously in terms of weather patterns, which impacts farming industry, but also in terms of banks and the corporate level. And specifically, a big impact on this crisis was the fact that there was concentration of risk in very few companies versus, for example, back in 2000 when many companies suffered as a result. So with that, if you have any questions, jump into classes. We'll see you at MarketTamer.com.